Something doesn't add up. The richest country in the world, the issuer of the global reserve currency, the backbone of the international financial system, is carrying over $34 trillion in debt. Welcome to Finance Library of History. Here, we talk about money, power, and history, and nothing is ever as simple as it first appears. That number is so large it almost loses meaning. Trillions don't feel real. But the consequences are. Every single year, the United States spends more and more just to pay interest on its debt. Not to build roads, not to fund innovation, not to strengthen infrastructure, just to service past borrowing. And here's the uncomfortable question. Is America slowly going bankrupt? To understand the present, we need to see how we got here. For decades, the U.S. economy has operated on a simple principle. Borrow, grow, repeat. When recession hits, the government spends. When crisis strikes, the Federal Reserve intervenes. When growth slows, stimulus packages are deployed. After the 2008 financial crisis, trillions were injected into the system. During the COVID pandemic, even more was added. Emergency spending became normalized. And while these measures may have prevented short-term collapse, they left some behind, a mountain of debt. Today, the U.S. debt-to-GDP ratio stands at levels historically associated with wartime. But this is not a world war. This is structural. Debt alone does not cause collapse. What matters is sustainability. And this is where things become complicated. As interest rates rise, the cost of borrowing increases. That means a larger portion of the federal budget must be allocated just to interest payments. In fact, interest payments are becoming one of the fastest growing expenses in the federal budget. Think about that. More money flowing to creditors, less flexibility for everything else, and debt compounds. If borrowing continues faster than economic growth, the imbalance, not overnight, quietly. So why hasn't America collapsed yet? Why isn't panic? Because the United States holds a unique position in the global system. The U.S. dollar is the world's primary reserve currency. Global trade is largely conducted in dollars. Foreign governments hold U.S. Treasury bonds as safe assets. In times of crisis, investors don't run away from America, they run toward it. This creates demand for U.S. debt. And as long as global confidence remains intact, the system continues to function. But here's the key word: confidence. Financial systems don't fail when numbers get large. They fail when there's roads. America doesn't collapse when it runs out of money. It collapses when it runs out of trust. Now imagine a scenario. Interest rates remain elevated. Debt continues to rise. Political divisions deepen. Foreign powers search for alternatives to the dollar. Individually, none of these cause disaster. But together, they shift perception. And markets are driven by perception. If major global players begin diversifying away from U.S. assets, borrowing costs could rise even further. That would force difficult choices: higher taxes, reduced government spending, more money printing, or inflation quietly absorbing the burden. Every option carries consequences. But there is another perspective. Some economists argue that America's debt is manageable precisely because of its unique position. The U.S. economy remains one of the most productive and innovative in the world. Its financial markets are deliquid. Its institutions, despite political noise, continue to function. And throughout history, predictions of imminent collapse have been wrong. Again and again. So is this just another exaggerated fear? Or is the trajectory truly different this time? That depends on one critical factor: growth. If economic growth consistently outpaces borrowing, the debt burden stabilizes. If it doesn't, the math becomes harder to ignore. Here's the reality. America is not going bankrupt tomorrow. The government cannot simply run out of money in the traditional sense, because as it controls its own currency, But printing money is not a cost-free solution. Inflation is a hidden tax. And long-term erosion of purchasing power slowly reshapes societies. Debt crises in advanced economies rarely explode overnight. They unfold over years, through reduced flexibility, through growing fiscal constraints, through gradual shifts in global power. The real danger isn't dramatic collapse, it's slow structural weakening. So is America quietly going bankrupt? Not like a household, not like a small nation. But the trajectory matters. When debt grows faster than productivity, when interest payments crowd out opportunity, when political gridlock prevents reform, risk accumulates. And when the largest economy in the world shifts direction, the entire planet feels it. The dollar anchors global finance. U.S. Treasury bonds underpin international reserves. American stability influences everything from oil prices to emerging markets. This isn't just one country, it's about the architecture of the modern financial system. The real question isn't whether America has debt. Every major economy does. The real question is this: can the United States maintain the trust, growth, and global influence required to sustain it? Because in the end, financial power is not just about numbers, it's about confidence. And confidence, once lost, is far harder to rebuild than any balance sheet. If you found this analysis valuable, consider subscribing. Because economics isn't just about money. It's about power, it's about history, and it's about the future.